Good morning and welcome everyone to the Schwab YouTube coaching channel known as Trader Talk. Today you are here for Trader Talk in today's market, and I am your host, Kevin Horner. It is a rainy morning here in Denver, Colorado. Always pleased to get a little bit of rain, but glad you are all joining us today. We've got plenty to get to, of course. We've got a day following the FOMC no decision. I guess you could say sometimes that if you choose not to decide, you still have made a choice. Well, the Fed decided no changes to policy. We also had a series of big company earnings yesterday after the bell. Some big names, some Mag 7s with which you're familiar. We're going to look at some charts there. We've had some reactions that went both directions, believe it or not. So we'll look at those as well as we will peer in on sector action and some industry movement also. So as always, a lot to get to with you all on a solo Thursday for me. Solo in the sense that I'm hosting alone, but I, of course, today am joined by my friend and fellow coach, Barb Armstrong, in the chat. So say hey to Barb. She'll certainly manage to answer comments and questions that I'm unable to get to, but I'll keep an eye on things for you all there as well. And if you're not doing so already, by following Barb and me on X, we would really appreciate that. And you're missing out if you aren't. Barb is going to be posting frequently throughout the week some great reminders about mentality and a wonderful view on and outlook on not just the market, but life in general. Barb is an extremely positive person. Love working with Barb. But if you're following Barb, you're going to get positive reinforcement on X. We love that. So follow us there. Barb Armstrong, CS, and Kevin Horner, CS, the best place to find us when we're not hosting classes for you here. Now, with that, let us jump to our disclosure page, which I'm going to load up here momentarily, and then we will get to our chart. So please, first of all, remember that everything we discuss for you today should be considered informational and educational exclusively. Beyond that, we do not make recommendations nor any endorsement for a specific approach to trading the market here. We will, however, utilize technical analysis as we review the broad indices, the sectors, and these individual equities. Now, it's important to remember that technical analysis is just one piece of your decision-making puzzle, not the entirety of it. So we discourage you from making your decisions only on what you see in the way of technical analysis. Now, as an agenda is concerned, we follow a top-down approach here today. That means we start broadly. So we're going to look at the biggest indices. We'll start with the S&P 500. We're going to look at the NASDAQ 100, the Russell 2000. On a Thursday, I tend to spend a little less time on these just because we've got a lot to get to. So we're going to briefly work through those big ones and then check in on some industry groups, sector action, and individual stocks, like I mentioned. So plenty to get to with all of you. Let's jump right to it. So as I said, we're going to kick off with the look at the S&P 500, which has continued to maintain some important levels here. The most recent level that we've held has been the gap zone created about 3 weeks back here on the 17th. Well, I guess only 2 weeks back, excuse me. That would have been 2 weeks ago this past Tuesday. We gapped to the upside and have had a couple of successful tests. You could see those with the low here. Run there, and then one, oh, I guess I could just extend it, couldn't I? Let's zoom in on that and just take my rectangle and extend the rectangle, because ultimately what we've done here is to test twice the same support, and now we've moved off of it pretty well. In fact, we got this nice move to the upside, followed by a brief 2-day pullback. Notice the tails giving you an indication of potential support right there. 1, 2, 3 in a row. If you're a trader who is only looking at the daily chart, you might be missing out on what could be instructive in a tighter window of time. I'm going to move this off to the 1-hour block and zoom into things, everyone. And those levels are still there. You can see why or how they have been held and tested. So, we've been incorporating horizontal support. We're incorporating trend support with this moving average. This is the 50-hour moving average in this instance, everybody. So you can see that when we pulled back here, we just kind of went sideways real quickly to consolidate. Now, we haven't moved to new short-term highs just yet, so we're waiting to see, can we get the breakout. And I think a lot of traders over this 7180 area, everybody, are probably thinking, okay, if we can get through 7180, we can see 7200. That's not a far stretch to jump 20 points from 7180 to 7200, and we know that a round figure like 7200 does carry some weight for the short-term traders. So we'll monitor that. We'll see if we can get through it. But this has been a good development for the S&P. And we could say something similar about the NASDAQ 100 as well, everyone. Noticing here the same stuff. We've got our gap move from the 16th into the 17th. It's been a little bit more of a strong rally in the NASDAQ here. Percentage-wise, it's been super. Back to March 30 lows to the peak we just achieved here this morning. How about a nearly 20% bounce back? Great move to the upside. We don't know about further continuation. We expect, of course, after big moves, we expect some semblance of consolidation. But remember, consolidation doesn't have to be in the way of price. We don't necessarily have to see a drop in price. We can just go sideways in time and allow these moving averages to catch up and create additional areas of short-run support for us. But the low made here 3 days ago on Tuesday, could be another area that some traders will use for risk management techniques. It's a little interesting to me that we got up into there and then didn't hold. So we'll see to what extent today's action continues to get pushed back. Here I'm looking at the 15-minute bars, and this is basically just taking us back to last Friday. You can see we've been to that level on the NDX, but we haven't popped through it yet. So the fact that we opened at that level and sold down is a little bit interesting, but it'll be more interesting for sure if we can trade upward through that 27,310 area and start to make new highs. The NASDAQ 100 is going to start to show some potential for more upside if it can do that, of course. But I know a lot of you are wondering, hey, can 20% rallies really continue to the upside? A lot of traders would say not in unabated manner, right? We commonly are going to get these slow consolidations, these brief pauses to the trend. Ultimately, that's what we ideally would like to see, right? Short-term, slow pauses that allow the trend to continue. It's hard to look, though, at the NASDAQ 100 and believe that it's anything other than bullish given the nature of our price action. So let's not take a view that says, oh my gosh, this has to come down. Let us allow the price action to dictate those decisions, right? We know that things can stay a little bit exuberant to the upside longer than we might be willing to stay betting against it. Whether you're actually positioning against it or sitting in cash by and using that as your definition of kind of not believing in what you're seeing here. But don't fight against what you see necessarily, but look for ways to manage our process. So we don't know what's coming from here, but we do have a few areas, a few levels that we can monitor that'll help us out. Now let's look at our small caps, our Russell 2000. Looks like we have pulled back to that gap zone as well. So, there is something to be said for the consistency of the trends here, all moving to the upside in similar windows of time, but doing so with key detail involved. That being that that Tuesday gap move that we got right here, when we got this so-called ceasefire, of the belief that we were going to get an extension to that has continued. And it sure feels in the last couple of weeks like what we've done is to more or less move the risk factors associated with a protracted conflict there in Iran to the sidelines. The market seems to be completely moving away from the concerns and risk there. Now, yes, we had a red candle day in a lot of areas yesterday because oil was moving to the upside. Oil had a big move there. In fact, let's go ahead and use oil. Take a look at oil real quickly. I'm going to use the future symbol on this, of course, but we are not utilizing it as a heads up to trade futures or anything like that. This is just giving us the idea and knowledge of what oil is up to. And so what we've seen here is, we could say, is an uptrend as well. We've clearly got that. It's been very volatile, admittedly. Most recently, we had a pretty healthy pullback after rallying all the way up to that 117. We've sold down all the way to 80. So we sold back 33% nearly. And then notice we've pushed aggressively to the upside. Even to where we are right now, we're back up 30%. So there is clearly volatility remaining in oil broadly, and yet the market is continuing to digest that and move on and not be as concerned. Now, I don't know how long that may continue. At some point, there will be, a diminishing scenario where the market's going to recognize that this conflict leading to higher oil for a longer period of time is inflationary, and at some point that'll shift, I believe. But we're not seeing it right now because we've got S&P, NASDAQ, Russell 2000 within percentage points or a stone's throw of all-time levels, all-time highs. We're not going to deny what we see there. But if we are uncomfortable with some of those moves, it makes sense to manage our risk a little more tightly. There's nothing wrong with that. Now, the move in energy, of course, if we take a look at how that has reacted with the move in oil, what we notice here is we've had a big move to the upside, a big bull move this year. In fact, if we put this back to just January, which began right here with this candle, this big green candle to the upside, what I've been talking about is this trend. So we had a move from our low on the 2nd of January to the peak up here, which came in at 977, just about 976.90. And so I'm just going to put us up there. That was a 42, almost 43% rally to the peak. And then we gave back a pretty good percentage, right, to the low that we just created here a couple of weeks ago, gave back about about 16.5%. But what's interesting to me about that is that entire move from here up gave back about half of the move. So we know that we get this commonly, right? We'll get a 50% retracement. And then if the 50% retracement is held, then traders believe that there's an opportunity for the upside or the trend, the long-term uptrend, in this case, the year-to-date trend, I guess, to continue. And you'll notice, yeah, we bounced off of it. Bounce off the approximation of the 50% level, right? We got below it intraday in energy, bounced, and you got a Cahold day right here, right? The close above the high of our low day, we got right there. So here was our low day, the high of our low day, I should say, was right here. And on this candle, we closed above it. This one was a lot less decisive. I mean, it was really close, but not decisive. The next day's candle was clearly decisive, closing well above it right there. And since, we've not come back to test, right? So you've had a continuation move. And then we had another level achieved in energy. We got above the confluence of the 20 and 50-day moving averages. And today looks like what would be, I'm going to eliminate my oval here, everybody. Yeah, this looks like day 3 above those. Some of you would say, it's just 2 days. Some of you would say, okay, I'll call it day 3. But regardless, if it's 2 or 3 and that matches what you define as your confirmation signal, well, then you might have a belief that energy's path of least resistance could be higher now, given what we've seen from this chart. The implication is that by rallying and pulling back 50%, holding the 50% level, making new short-term highs, that you traders could believe that we can go back to where we were and possibly even higher. That's what remains to be seen. Now, that gives you a couple of key areas to monitor. Some traders will look at the 50 days, some will look at the 20, and then some are going to look back at the low we created back here 2 weeks back. Have a plan, adhere to the plan, right? Plan your trade, trade your plan. We say it all the time. So energy, an interesting group right here. I am also today talking a little bit around the financials. Now the financials are in red right now, down about 0.25% this morning, but the chart on the financials is interesting because we are testing the low we created from Monday and Friday, and Thursday of last week, along with the nicely sloping upward 20-day simple moving average. So we've got possibly here continuation of a new short-term uptrend here, right? So we've got this downtrend that was working, okay, off of this peak. So we pulled back pretty aggressively. If I draw the line in here, well, if I, oops, I've got the arrow instead of the line. Let me try to change that. All right, here we go. So the sell-off in financials was about 15.5%. So that's reaching what many would call simply the correction phase, right? Anything but 10 to 15% corrective in nature. Pulled back that amount, broke the channel here with the action we've now had for basically, well, back to April 8th. So even though the broader market didn't make the move until the 17th of April, you've seen financials make that move earlier. And so what we've got now is potentially the newly developing short-term uptrend here. We broke out, held the gap, essentially held the gap. There's been some short-term action in here, right? But basically held the 50-day moving average, and today are holding the horizontal support there at about 853. So that looks a little interesting. From a trade standpoint, I'll bet you traders would feel a lot better, though, with a move through those recent highs where we paused on this bounce, and that would be up here in the ballpark of about 880 on this particular index. But making new short-term highs, that would look like a validation in financials. And I would say to that, yeah, Rita, I would say that there is a higher low is how I would look at it. I would call, this our bottom, essentially, right? And the breakout, this is still a low, but this is higher than any last lows, right? And then this low that we just made today gives the impression that we're holding support at around 854. Doesn't mean it has to hold there, right? But it could. And if it does, then traders are going to be looking for the opportunity to rally into the same high we created just 2 weeks ago. Now, if you're looking for management techniques, I think a lot of traders are going to look at the low we did make here on after the gap. That low is just below the 50-day. And so while the 50-day could be incorporated, some traders would just say, give me the lowest level since the gap. And then I will start to look at that area for an exit strategy. Some of you traders will go really tight below that low. Other traders would incorporate the average true range below that level. But whatever the case, have that plan, know how you want to approach it. Let me see here. Carol, I saw your question talking about the yen carry trade. I'm aware that this is potentially a risk factor that we have to be watching for, but be perfectly honest, it is not something that I can discuss with any true knowledge beyond the expectation or maybe watching it. I would know enough to know that if we saw a shift in rates in Japan, that it would very well have an impact on us, and it's something that could impact the market in fairly negatively, as we've seen in the past. But expectation for it, likelihood of it, so on, I just would not have enough detail or be versed enough to answer that in a better manner than I already have, and I apologize. I'll have to dig into that, learn a little bit more, and maybe I can answer that with some greater clarity in the future for you, Carol. So sorry I don't have a better answer at this point. Okay, let's look at a couple other areas in the market here, everybody. Industrials. Industrial space has maintained nicely if you're looking at it from a bullish standpoint. I've put in a rectangle here. I'm going to lift just to highlight again the importance of these gaps, everybody. We know the importance of gaps, and gaps frequently get tested. Well, that's exactly what happened here, isn't it? We broke out and then we've just consolidated. So the lows of this last 3 weeks have been consistent at this approximation, right? These same levels, and we've bounced off of it. Here, we've got resistance above us, so we've got a little bit of a band, and we can take an approximation of the height of that band. And of course, you all know that when I draw these lines in, we are doing this from a standpoint of approximates, right? We cannot be too too fine in our establishment of support and resistance. Some of you traders would say, I want to have that line a little higher. I want to capture the absolute high in the range. Fine. But what we might want to do if we did this, to just get an estimation, right, of where we might see something moving, well, we'll just measure the height of the range that we have to work with. And if the range gets broken to the upside, well, then we take that line, add it to the breakout level, and now we have a possible target. And so you might duplicate your line and put it up to here, and you might even define it. You might just put in a little note, target zone or something like that, right? All right, so I'll just put in a note. Now I've got something to watch. Okay, now alternatively, all right, what if it didn't hold up? What if it broke down instead? Well, the same move could be made to the downside. So just take our levels once more and we just redraw, right? So we don't need to be too fine in our approach, nor do we need to act in the midst of this consolidation in here, right? This is just that. If you're going to trade this space based on a break, wait for the break to occur. If it closes over the upper level of resistance, traders can possibly buy and trade for the potential to get to that target. If it trades under this zone on a closing basis, some traders would trade bearishly to the downside with a potential target in this vicinity, right? And again, this isn't rocket science by any stretch, and we know that this stuff won't work 100% of the time, but this is a way you might be evaluating industrials. And industrials have held up pretty darn well. If you went and did a scan in this space, you'll probably, I think you might be apt to find a few examples that would reflect uptrends having maybe pulled back to areas of potential support. Okay, so there's a look at the industrials. Another one on the move today. We've got discretionary, I think. Let me double check on that. Nope, I'm wrong. I got the wrong one. It's staples that's moving upward today. This is a real interesting development in a defensive space, everybody. So when I mean by interesting is that we are moving through that 50-day moving average to the upside. Now, the group itself, we've been below that 50-day dating back to March 18. So that stands out. It's been about 6 weeks, and we have now put ourselves back to that gap zone. Remembering the importance of gaps, we have essentially filled that gap, and we are in a window now whereby we might be able to move through and make new short-term highs. Right now, we are almost trading at the highest we have in 6 weeks, and that could be a new bullish development for the staples space. But what does that maybe imply about the broader market? Well, I can't help but be reminded that in a risk-off situation, when the market is far less comfortable, we are more likely to see defensives leading, like a Staples, for example. This is one of those groups that could do better in a risk-off trade. And if this is suddenly breaking out to the upside, it could be a little bit of a heads up on the broader market. Bears watching. Let's take a look at healthcare. Another one that could be a little defensive in nature, but it has sold down aggressively here. We have an interesting candle yesterday because we made a new short-term low, but it was a doji essentially closing at the open price there, which is often considered an indecision candle. So traders trying to make heads or tails of that move. But given what we got there, you make a new short-term low in price, but a nicely higher relative strength indicator here telling us we have a bullish divergence, which, doesn't necessarily tell us that the trend is absolutely going higher from here, but it could give you the belief or could give traders some comfort to think that, hey, maybe this recently established low can now be held. Okay, so you do at least have a divergence, and some traders who are aggressive bullishly here might get started on a trade like this, for a couple of reasons. Number one, it has pulled back pretty aggressively. And number two, we have a divergence bullishly. Number three, if this is the lowest low in the trade, in this drawdown that we're witnessing, and it's certainly the lowest we've seen in 6 months, well, then today gives you a potential hold once more, right? A possible close above the high of the low day. Right now, it's simply a trade above the high of the low day. So this could be a spot where some traders chose to get going. And maybe this is where healthcare gets its act together a little bit after having pulled back pretty aggressively from what some of you would call maybe a double or perhaps even a kind of a lengthy, protracted top there, complex triple, something along those lines. The clear level now, in hindsight, as is often the case with technicals, is the time to move on was when we broke that short-term uptrend. As you can see, we got decidedly more negative thereafter. Okay, I did see we had a survey there in the chat, everyone. Thank you for reposting that, Barb. I really appreciate that. Your feedback is always valuable to me, everybody, especially on a Thursday when I'm here alone. I love to hear from you because in the past I've heard that we need more exploratory conversation around individual equity, so we're going to move to that momentarily. But regardless, your feedback is very helpful to me. Any comments you make, those come directly to me as well, and I'm always appreciative of your comments, your questions, your ideas. Thanks for sharing those with me, everybody. Let's see, more chat commentary. Looking for questions. Okay, all right. So we're going to keep moving here, everybody. Let me see about... All right, so just before we get to those individual equities, I wanted to highlight movement we've seen today in a couple of those defensives, right? So one, again, utilities making a significant pop to the upside here. So that means perhaps yields are pulling back, and sure enough, yields are not really pulling back because what we've mostly seen is upside to the yield situation here. Utilities rallying nicely though, and I'm of the belief that if utilities are rallying, it's with the belief further that we're going to see lower yields down the road, but that's not how traders are currently positioned. So even though we got the FOMC decision to hold steady, what we've noticed is expectation for a rate cut is basically non-existent now. We go out through the end of the year, and the likelihood of us maintaining status quo on the current policy is in the high 80s through the end of the year. Your immediate months are more like high 90% likelihoods according to how the traders are positioned, but that tells us something about what the market thinks in the way of Mr. Warsh's possible ascension to new Fed governor. So we'll see how that goes. We also noted that real estate has held up better. Now, I don't have a good story here because, again, higher yields imply weakness for real estate sector for the REITs. Remember, that's what this group is. These are not your home builders per se, but more likely your commercial real estate companies and your real estate investment trusts. Again, we're not recommending REITs as an investment. I'm looking at it from a trend standpoint. And when you look at this chart, everybody, I'm pretty confident that many of you usual suspects here, and many of you who might be here for the first time, you know exactly what we're looking at here. This is about as clean currently of a bull flag visually as we're going to find. You have about 11% rally. We've had a test of a gap zone, happens to be the same gap level that the rest of the market get tested. And so we've gone sideways now for about 2 weeks in this area, allowing the 20-day moving average to get caught up. And some traders would look at this and say, all right, there's my opportunity. We've got a short-term uptrend in place, covering about, let's see, where was the time frame? About 4 weeks? Oh, 3 weeks, I guess, to the upside. And then a quick 1.5, 2 week pullback. And you're just waiting this out to see if we can get continuation. The low day, the lowest trade we've seen since the peak was on this day. And so we would maybe give thought to getting through this level, the high on that day. Can we close over that high? That high was 280.59. So if you can get above 280.59 on a closing basis, some traders would look at that as a close above the high of the low day, and anticipate continuation in the real estate sector thereafter. Okay, that brings us to about 15 minutes to go. Let me just double check on my review here. Okay. Yeah, you're right about that. Ongoing process, learning the Thinkorswim platform. Yep, there's a lot of that. That never stops learning, I'll tell you that much. I mean, I continue to play with this thing every single day, make adjustments, learn something new. I try to bring that when I learn something new, I feel like, hey, that's a possibility of sharing something. So I do try to bring those to the table where I can for you all. All right, let's go ahead and devote the remainder of our window of time here today to looking at the stocks that have been moving on earnings and so forth. So we do have a couple of these that were upgraded, a couple that were downgraded, and I just thought we should look at them all. So Alphabet, let's start with that. I don't have upgrades on Alphabet, but we do have a nice move underway here at least initially, up 6% now, 20 points. Alphabet made a lovely move out of after consolidation. So what's interesting, and obviously we know that these earnings have huge play on the price action, as we know, but this was notable because we made new highs basically through, make sure I've got my line in here. This is what I wanted to draw it in, was basically right about here. So we'd had this breakout, and going back to what I frequently talk about with you all, the idea of defining confirmation. So again, this one we moved to new highs, right? Held the level of the breakout for 3 days. So 1, 2, 3, we moved through it, but we didn't break out, and it required the earnings to move to the upside, and that's exactly what you got. And so if we're talking about Alphabet from a standpoint of potential expectations going forward, many traders are going to look at today's action and define this as great. We have a possible continuation rally. What can we do from a possible participation standpoint? Well, we never know how long the breakout will run, or if the breakout runs and never comes back. It's possible that the low we just created with the open today is going to be a level against which to base any risk, right? Some of you traders who may be long the position into earnings might set an exit strategy just below today's low for a portion of your trade to try and capitalize on the upside movement, and only selling some in the instance that you start to fill the gap in over the coming couple of days. And that's just because, you might want to pat yourself on the back for a trade well made. Alphabet is trading at all-time highs, as you can see here on my weekly, but just because it's at all-time highs, and again, that's not a bearish scenario, but you traders, if you're trading for the purpose of trading, well, then we got to sell at some point, right? And I'm not telling you that that's the point to sell, but what I do want you to do is be prepared to take action. Now, I don't know your preference. I only know mine, and mine is well defined. And I encourage you to do the same. Define your preference. So for some of you, as usual, it's going to be, I want to sell as we're making highs. I want to sell into strength, pat myself on the back, sell only a small portion so that by selling that small portion, I can stick with the remaining portion even longer. Because now that I've reduced the size of the position, any give back the stock makes is going to impact my trade less and my portfolio less. So some of you are going to say, no, I don't want to sell on strength. I only want to sell when it brings weakness to the table. Well, where would that weakness be? For some of you, it's the gap low. Others, it's the breakout low, or the level of the breakout, 343 or so. My question though is, if it's 343, are you really comfortable giving up $28 a share in your current situation, your current price level versus where you would sell? You're telling me that you'd rather drop 28 to 30 points and then sell rather than selling a little up here, right? This is the conversation you need to have with yourself. It will aid you in defining your preferred manner for exiting, right? Not everybody's going to do the same thing. And so, what I try to do in these conversations is remind you of that. You have a number of ways to do this. Many traders are very much black and white, all in and all out. But if you are all in and all out, and your emotions are hindered because you do that, that is to say, oh, darn it, I sold the entirety of my trade at that upper level and it kept running. Now, what do? If those are the thoughts you have after selling a winner, well, then maybe you want to be a seller of just some. Pat yourself on the back, elevate a stop order to a level you'd be happy to sell the remaining shares on. As usual, have a plan, know what you want to do, know what it is that's going to make your decision making process easier on you and easier to manage after the fact once you've sold. One of the reasons traders like to sell a little and keep a little in these instances is because you're right both ways, right? If it goes higher and you have sold half, great, you've got half waiting there participating. But if you sold half and it goes down, you were right to have sold. You were right both ways. So if you battle the emotional tie to your trades like I used to do, well, then give some serious consideration to layering exits and entrances. It can be helpful in that way. All right, let's bring in some other ones. How about oh, wait, by the way, I needed to let you know I had two increases to Alphabet price targets. TD Cowen raised their target to 450 from 375. They maintain a buy rating. And Pivotal Research raised from 420 to 470, and they also maintain a buy rating. Let's look at Amazon here, everybody. All right, Amazon. Today we've got a huge candle that was favorable off the open and has faded a bit. From a technical basis, it hasn't destroyed anything, as you can see, because all we've done is show that the lows that we hit today are consistent with the prior highs. So we've basically managed in the same day to have a breakout and a support test somehow. And this is interesting because the support is also at the prior highs. So if I go back to, mid-October of last year and drew this line through, I think it's kind of notable that we've held with this little flag. The low here today kind of tested that exact same area. So there's been some interesting price action on Amazon over this 258 zone or so. Now the 20-day moving average is pretty far away. It's down there at 244, about 15, 16 points. So that's pretty significant. That's a lot to give up. And some of you traders might just look at that recent low in here and say that you might balance your risk against that one. Headlines on Amazon. Amazon is in discussions with someone close to the president about a potential reboot of The Apprentice, according to my headlines. Intentions perhaps to put Donald Trump Jr. as the host. Additionally, Citi analysts raised the target on Amazon to 325, up from 285, and they maintain a buy rating. Citi is incrementally positive on Amazon shares following their Q1 report. And then the last note I have on Amazon is that Barclays raised the target on Amazon to 330 from 300, and they maintain an overweight rating following the Q1 report. All right, how about some things that haven't quite gone the way that y'all had hoped? Let's take a look at Meta. All right, so Meta had been doing wonderfully of late, right? You got a great rally off of those March lows, pushed all the way up to the 200-day moving average, rallied about 32%. And then it looked like we were maybe consolidating at resistance. This is an excellent reminder that not every bull flag, and this could have been defined as a bull flag or maybe even a pennant, right? Not all of them are created equal, are they? Right? And when I say that, what I'm referencing is bull flags at resistance are very different than bull flags with no resistance or blue sky us up above us, right? So in this instance, yes, we got hammered on the earnings, unfortunately. If you were incorporating a stop order, you probably got stopped out today. If it was a stop limit, you certainly have the opportunity. You might still be in your shares if your limit was above today's high, which today's high is shy of 621. But the stock's taken a bit of a beating here, down about 10%. Now, Meta was downgraded at JP Morgan to neutral. Previous target or previous rating was overweight. A new target here is down about $100 a share, though. Prior target was 825. They put them now at 725 following the Q1 report. So we've got it down about 10%. But JP Morgan does state that they are encouraged by Meta's 33% year-over-year revenue growth in Q1, which was supported by AI-driven advertising strength, but the company's increased infrastructure spending and lack of visibility into their AI product pipeline warranted the downgrade, according to JP Morgan at least. So that was a pretty significant development. The earnings poorly received, and the downgrade really hammering Meta here at this point. If you're a trader looking for any green shoots as it relates to Meta, we could suggest that there might be some support in this vicinity. We've been in this area before. We've managed to bounce out of it. This would be important for a lot of traders. If we traded under this rectangle, which is basically at 590, that is going to be more bearishness than many can sustain. And if we look at the ledge beneath us, what are we talking about? Well, it's basically, look, the opportunity is if we take out the low that this zone of support, or maybe even you could draw it all the way back to here and suggest that it's under this ledge here around 580. Well, then that gives you the potential to be back at about 520. That is a significant move. Again, we don't know that that's how it plays out, and technical analysis doesn't help you see the future per se, but it does give you ways to manage your risk and decide where you would lighten up position size or tighten the purse strings, so to speak. Those are the things we try to do as much as possible. Okay, how about another one? Yeah, let's go ahead with that, Sockeye. What do you say? How about Microsoft? Microsoft definitely in the news. So Microsoft, they were lowered price target at Barclays today to 545 from 600. Barclays maintains an overweight rating on the shares. Wells Fargo raised the target to 625 actually from 615. They maintain an overweight rating following the quarterly results as well. Here, from a technical standpoint, everybody, I mean, what did we do? We broke consolidation and we pulled back to the 20-day moving average. Again, if you're a trader looking at these and you're deciding, well, which one of these moving averages is the right one? Could it be the 20-day? Sure. But the 20-day today, let's see here. The 20-day is 403.27 and the 50-day is 395.69. There's a difference of about 7 or 8 points. It's kind of limited, right? So if you're a trader looking at the 20-day, you're basically, you might be right, but at the same time, why not go with the 50-day right there? They're very close, and you could certainly manage risk with one or the other, okay? And even still, some of you would say, I like the 50-day, but I'm going to go beneath the 50-day to manage risk by the amount of the average true range. And in the case of Microsoft, that average true range is about $12.50. So you do have to give it some semblance of wiggle room, but if you're looking to stick with it, you ideally would like to see it maintain the 50-day moving average in the near term here. A little bit of confluence of late as well. So some horizontal support right around this 392 area as an approximation. So there's your Microsoft look, following details. Let me see, I've got anything else in here. Oh, we've got an upgrade or two. How about a couple of interesting upgrades? Let's try a quick look at Qualcomm. Qualcomm was upgraded at Summit Insights to buy from hold Following their Q1 report, the firm believes that negatives are priced into the shares and the company is pivoting towards AI. Qualcomm's diversification efforts beyond handsets will determine its trajectory moving forward, according to the analyst. But Summit believes that Qualcomm's Apple share loss and weakness in the Android market are now officially priced into the stock. And yes, the stock has been on a bit of a downtrend, as you can see here. I'm going to make this a 2-year chart. Yeah, there's your peak way back there. But if that bottom is legitimate, and look, we're getting some validation of that. Look at the RSI. That's the highest we've seen the RSI since that last peak in May of 24. Goodness. So, this is a dramatic shift to the trend. Try not to get ahead of ourselves. Remember, we've managed, if you've been in this one, you may be managing risk with gap levels, right? There's one gap level, and then there's another one up above that we just created with today's move. So you've got a few things to look at there. Could we see resistance at this ledge here around 184? Certainly could be. Nothing to suggest it doesn't have to, does not act as resistance. You could always color these properly to kind of remind you as you're looking at them quickly. But a new developing pattern, something that could lead to some optimism further for Qualcomm. And then the very last one was on AbbVie. They were also upgraded today. AbbVie was upgraded at Bank of America. Now, the pattern and chart on this one doesn't seem to be quite as ready to go. You do have a bullish divergence down below with the RSI that was in oversold territory. This time on the last low didn't get to oversold, so you've got a higher low in the RSI. But watch that 50-day above us. We do have the death cross here with the 50 crossing the 200 to the downside. So this could easily act as short-run resistance. But nonetheless, AbbVie upgraded for you today. All right, everybody, I think we are at time. We are going to need to wrap it up. Big thanks to my friend Barb in the chat. We do have that survey link and would absolutely appreciate your comments and thoughts and ideas on the class. So if you take a minute to let me know what you think, I'd appreciate that. Remember to follow Barb and me on X, Kevin Horner, CS, Barb Armstrong, CS. And if you like this discussion, hit that thumbs up button for me. We're going to get this reviewed and into the archive as quickly as we can for you today so that it is ready to go. And that thumbs up helps us out quite a bit in the YouTube algorithm. Last note, remember tomorrow, National Investing Day. That means our Friday session is very different. So check the calendar, get registered for the classes we have tomorrow. James Boyd and I will be on with you at 10 a.m. Eastern. That is 8 a.m. Mountain, 30 minutes past the standard, but we will not be hosting Trader Talk. That'll be a different discussion altogether. So please check it out and join us tomorrow for National Investing Day. And with that, thanks for being here. Have a great rest of your Thursday, everybody. I look forward to seeing you all again real soon.